Hello and welcome to Young Turks, India's longest-running show on startups and entrepreneurship. I'm Shireen Bhan. Now, this week on the show, we kick off a special series called the Unicorn Health Check. So over the next few weeks, we aim to create a report card of our most valued startups, delving deep into what's working and what's not. Now, the Russia-Ukraine conflict and Fed rate hikes that started in early 2022 triggered fears of a global recession. That caused the Nasdaq's worst single-day plunge since the pandemic, resulting in a tech rout which meant that the world's top venture capital funds saw billions being washed off their books overnight. Now, this turned new age tech firms into riskier investments. As the era of cheap money ends, India's unicorns, which were once the darlings of this 13-year bull run, were hit hard. They were driving fast without the necessary brakes, prioritizing growth over profitability. So barring a handful, what do India's 100-odd unicorns have to show for more than $80 billion of investments? Eye-popping losses. If we look at just the top 5 loss-making unicorns, their combined loss for FY22 stands at 18,500 crores, while their combined valuation stands at over 2 lakh crore rupees. We have not included the newly listed new age tech companies and India's most valued startup Byju's, which is yet to report its FY22 earnings. Now, the company reported a 4,588 crore rupee loss in FY21. And this brings us to the core problem facing these billion-dollar companies, and that is cash burn. For the purpose of this conversation, let's take a look at the unicorns that have the worst unit economics. We've picked only the ones that are spending more than 2 rupees to earn a single rupee of operating revenue. Now, during our research, we also found that cash burn of about 1.5 to 2 rupees to earn every rupee was, and I quote, the standard practice at most unicorns in FY22. So take a look at the numbers here in terms of the kind of burn that some of them are seeing. I want to bring your attention to the last column, and that is the revenue multiple measure. A startup's valuation to the revenue it generates is that metric. Simply put, it tells us how overvalued these startups are. ShareChat, which is burning nearly 10 rupees to earn a single rupee of revenue, is valued at 112 times more than its revenue in FY22. But the most overvalued unicorn is open at 195 times its FY22 revenue. And therefore, it's not surprising that of the 50-odd unicorns that have declared their FY22 numbers, only half a dozen, that's right, half a dozen have reported a profit. But why are we seeing these valuations? Well, simply put, the COVID-19 pandemic fueled overestimation and funding for these billion-dollar startups. However, with funding drying up, unicorns are now course-correcting. From growing at all costs to finding profit by reducing cash burn and cutting out all expendable costs. Unfortunately, that's also meant layoffs. Years of hiring ahead of revenue has led to last-ditch downsizing. Over 20,000 jobs were cut in 2022, with Byju's and its edtech peers leading that list with nearly 9,000 layoffs. This year, in January alone, startups have cut 4,000 jobs. However, there is a silver lining. For the first time in 7 years, founders have shown a preference for profitability over growth. A recent report by Innovent Capital shows that 55% of the founders have started to prioritize profitability in 2022 compared to just 17% in 2021. 6 out of 10 founders are now striving to achieve EBITDA profitability over the next 2 years. Well, that's the balance sheet of India's billion-dollar startups. While there is a lot of palpable pain in the system, there's also a silver lining. Founders are now singularly focused on turning black on the bottom line. 8 out of 10 founders are focused on building more sustainable business models. Well, resilience has always been the hallmark of a successful entrepreneur, and as they march towards a greener balance sheet in an uncertain economic environment, what will the playbook to achieve profitability look like? To answer those questions, I'm joined by Karthik Reddy, the co-founder and managing partner at Blume Ventures, and Anand, Lunia, the founding partner of India Quotient. Gentlemen, appreciate you joining us here on the very first special episode of our Unicorn Health Check. Karthik, let me start by asking you, and let's address the bad news first. There are global macroeconomic headwinds at this point in time, and the era of cheap money, easy liquidity is over. We're now in an era of high inflation and high interest rates, and that is going to impact fund flows across the world. India is going to be no exception to that. How do you see this impacting the unicorn story as it is playing out today? What have been the most obvious problems that the unicorn ecosystem is faced with on account of the global macros today, and how are they trying to mitigate this risk?
I think, depending on global liquidity to build good businesses is a very risky proposition, only because it skews incentives towards like unsustainable long-term economics. And I think having such a long bull run probably corrupted the market far more than it should have. Usually you don't see such sustained bull runs and such bouts of liquidity. So I think it's a very unique situation in startup history where this has happened, and India was well placed to ride all of that for 13, 14 years, other than a small hiccup in 15, 16. So there's an entire generation of entrepreneurs who don't know any different, right? And so that means that they essentially have been trained and been given role models and been given capital to build in a certain fashion and prioritize growth without necessarily understanding what the end state of the business needs to get to. And that's what's, in my opinion, led to this. There are no role models who have established that it is possible to build sustainable businesses. Enough entrepreneurs in India have done it before the startup boom, and sadly, chasing a status unicorn or otherwise was deemed more important. But the question has always been, how does that end, right? I mean, so how does everyone get liquidity? How does everyone, get an exit? And I don't think that's ever been contemplated deep enough. And I sound like a broken record. I've been saying it on your show and in blogs for 3 years, that whether it's an acquisition, whether it is an mid-market acquisition, late-stage acquisition, whether it's an IPO, whether it's a secondary, usually, unless it's super frothy, which happened maybe in a dozen companies, all of those are generally a mark of how companies would get valued in the public markets. Nobody comes and buys an asset for cash at $600 million unless they believe it is sustainable and path to profitable, right? So to postpone it was just wishful thinking. I think everyone's got caught in a liquidity trap, given that cross-border money used to fuel a lot of this, and they have other priorities. And it's something that India has understood in public markets before. It's no different in private markets, that when there is a crisis, people will focus on their home territory. That's what they understand the best. As much as they love India, they're not, it's second or third priority for most folks. So essentially, then you're asked to fend for yourself. And so thankfully, a lot of folks have plenty of money in the bank. The question is how smartly do they use it? And as all of us know, for that math that you showed on dollars spent to earn revenue, a bulk of that goes in silly customer acquisition, or it goes in inflated payroll costs. And both of those are being cut down harshly to be able to see whether there is a sustainable business model that each one of them can build and survive and fight another day. I'll take a pause. I'm happy to add once Anand also adds his views.
Yeah, I don't know if Anand is with us. I thought that we snapped that link with him, but if he is, Anand, are you with us?
Okay.
Yeah,
Yes.
great. So Anand, just to pick up on where Karthik left off, this liquidity trap that he spoke of, and of course what we are seeing at this point in time is the emphasis on trying to bring down burn because you have no choice. But the runway available, the cash runway available is probably different for different unicorns at this point in time, and that poses a different kind of challenge alongside the burn challenge. What are you most concerned about as you look at the picture today, Anand?
Shirin, first of all, it's good to see ShareChat on the top. I'm one of the earliest investors in ShareChat. Of course, for the wrong reasons here in your revenues. But I just want to put one nuance before I answer the question, that there are some businesses which are network effect businesses, which are sort of, a Swiggy, for example, or an Ola, for example, or ShareChat. These are monopolies or duopolies. And you can't really expect them to be profitable in the early years. Eventually, of course, they have to. And so with the exception of these companies, I'd say, of course, we have a serious problem. Our problem is compounded by the fact, like Karthik alluded, that we don't have role models. We have some case studies of failures,
Huh.
but nobody wants to think of Zoho or Zerodha. I really wish, Shireen, that these two gentlemen had raised even a small VC round. We could have said, okay, they are also VC funded companies, but my founders don't want to consider them as role models, right? So today in the startup ecosystem, we are almost devoid of role models. And that's the challenge, right? I mean, of course, we can cut down cost. It is cutting cost. But what is the role model? What is the path from here? We're yet to see. If you look at the public markets, there was a little bit of a hope in Nika because they were holding fort before above the IPO price, but even that's fallen. And if you look at Paytm, it's sort of hovering around the mark. And I'm hoping that from these few listed companies, one of them will emerge as a role model, few of them, and that'll be the path shown to everybody. It's sort of clear that the era of empire building is over, right? And that unfortunately was the focus of everybody. That people were building empires which would be lot of users, multiple businesses, and some of them would be like acquisitions of everything that is there in the same space. It was too much of financial engineering and too much of empire building, whether it's hiring big teams or whether acquiring a lot of customers or companies. I think that era is over. I think we'll have to focus on wealth creation. And I think it's coming back to wealth creation. The early investors will always be sort
Yeah.
of, okay, but we have to create wealth. And I think we have to also view IPOs as a way of continuing wealth creation instead of using IPO as an exit. Right? The founder has to have a horizon of 10 years after IPO also, before sort of, handing it over to a professional management.
Anand, I'm glad that you brought up ShareChat, and very often on the program or off of it, investors find it very difficult to talk about their own portfolio companies, and that's what I want to understand from you. Burn rate of almost 10 rupees to earn a single rupee, Anand. How do you explain that?
Yeah, Shirin, it'll change. Give us some time. If you remember, ShareChat on paper sounds like an 8-year-old company, but more than half of the company was built in just last 2 years, right? When TikTok was banned in India, we haven't missed TikTok, right? I mean, just imagine a very large, massive platform which was very popular in India has vanished, and nobody's complaining to you or to me, right? I mean, we don't miss it because there is ShareChat, there is Moj, there are a few others, and a lot of this, we have like about 10 crore people using ShareChat and Moj every day, and for probably half an hour or so. And all of this has been built in just last few years. So it looks like an 8-year-old company, but actually is a 3-year-old company. And having said that, this ratio probably will be better by just 5x next year itself, right? So, like I said, you'll have to give a nuance and a little bit of leeway to a network effects monopoly, where, for example, Shireen, Twitter, right? I mean, wasn't profitable till date, and yet sold for $52 billion, right? I mean,
Yeah.
that's like the mother of all deals. WhatsApp had infinite because zero revenues, and was sold for I think $16 billion, right? So some of these companies, Instagram, for example, was sold very early, again, very high price. These companies do have this nature. And I'd say that, we will have to distinguish them from other plays which are not necessarily monopolistic in nature or don't have network effects which you can monetize.
Okay. No, I understand that, but you're saying that you believe that the numbers are going to look significantly better for ShareChat, primarily because it's now entered in a space where a vacuum exists. But Karthik, to the point that Anand is making, and I think that's the thesis that everyone is hoping or keen to bet on, is that, look, India continues to be a growing market. It is a growth market. We're adding consumers on the internet and outside of the internet as well. And that gives people comfort that while there may be palpable pain at this point in time, over the next 3 to 5 years, hopefully, there is cause for things to turn around. Whether it's the network effect or not, Karthik, how do you read the market estimates at this point in time and link that to what we are seeing with the burn continuing as is and the efforts to try and pivot to a more sustainable business model?
So I think the only thing I would disagree with Anand here is that you got to size the risk that you can take relative to the reward in terms of what the revenue potential or market potential of a different geographic market is. So I feel some of the bullishness around funding or estimating that usage will translate to revenue, or revenue will translate to profitability, are a little misguided when you look at a very, very tight value conscious market like India, right? Advertisers value conscious, consumer is value conscious, enterprise is value conscious, SMB is value conscious, right? So if you say that I'm creating new behavior and therefore I'll get paid for it, the difference is to what Anand raised, that Facebook and a Google can see the potential of attention and eyeballs as huge advertising revenues in the US. There's no way we're getting there in the next 10, 15 years in India, right? Even as a fraction of their advertising revenue potential. And therefore, eyeballs don't count for that same end state, right? So all I'm saying is, of course, we should build companies like ShareChat, and we should build companies, hopefully, who can sort of compete with Twitter. But I'm saying it has to be balanced out with how much capital you can throw at the problem.
I think this is a conversation that, we see happen in parts. But Anand, respond to the point that Karthik just made. And I like the way that he put it. Usage doesn't necessarily translate into revenue, and higher revenue doesn't necessarily translate into profit. And we're seeing that in example after example within the unicorn ecosystem in the country. And to this point about comparing us to the US and China and so on and so forth, I mean, just on the back of per capita, where we are versus where some of these other large developed markets are, and the ability to hence spend, the discretionary power and ability to spend is very, very different. So has there been a gross overestimation, which is now going to be a challenge and a problem as the money starts to dry up?
Shirin, I agree with Karthik that there is a particular size that a company can grow in India within, let's say, a 10-year time frame, right? But if you look at, for example, Paytm, we've all watched that company and a lot of motions. One thing is for sure that the top line continues to grow at a very healthy pace, still 40% plus. Now, of course, if the situation of the country, and there is a little bit of a sidestepping there, that when you are competing with two global multinational giants, one of them being Google, a company like Paytm, unfortunately, doesn't really have too much of an option of, being profitable subscale. So the challenge, of course, is that, but at the same time, there are companies, for example, Zomato and Swiggy are to a duopoly. Uber is out now and everybody else is practically out. And these two duopolies, of course, will have to take, if you look at Zomato, they're doing the right thing, where they're sort of shrinking the order volume growth and reducing the number of cities, shrinking their footprint, taking the right step, because I think some of that growth can happen later, and we'll have to play to the market and look at the funding cycle. I do agree that you can't sort of use one bubble cycle to go to IPO. I do feel that some of these IPOs were premature. They were a little bit opportunistic, and we did use some companies did use public markets as dumping ground. Learned the lesson. Unfortunately, they have spoiled the pool for all the people who will follow. And I think and we'll all have to battle that. But there are some Info Edge continues to be like a good company there, a great example. India Mart has done fabulously well, right? Yeah, so there are some examples, and
we were talking about the lack of role models. I mean, these are role models that have stood the test of time. You spoke about India Mart, you spoke about Info Edge, you spoke about Zoho.
Very few, and I wish there were more role models, right? The problem, however, last year being a quiet year, right? everybody is getting, what happens is all of these role models are not relevant when there is another crop of founders who keep raising money, taking secondary exits, and all the shenanigans and lifestyles that comes along with it. I think in the quiet time when all founders are seeing the pain of layoffs, etc., I think we'll probably now look back to the real role models.
Karthik and Anand, let me end by asking you, to Anand's point on Zomato, where there is a conscious focus now on ensuring that they get to profitability and fight the next growth battle another day. Karthik, at this point in time, what we've seen from many companies is scaling back on their growth plans, scaling back on plans of going international and so on and so forth, focusing on the core business, shutting down businesses that were non-core to start with. What do you like about the thinking and the execution at this point in time?
No, I think, it's, as they say, what doesn't kill you strengthens you, and here you actually have no option really, right? And so I think you can put a sugar coating around it, but there is no option. Survival is the first game here. And building to this end state of sustainable, economics is a natural, choice that everybody has to make. Whether they're playing for 1-2 year strategies or whether they're playing for 5, 8, 10 year strategies. There's no running away from that, I feel. And, so my pro tip for everyone, and we are doing this, is essentially walking every relevant company in the portfolio, which has the mindset to think long-term, actually fight the battle, survive, is to show them relevant role models, either within the portfolio or in the public markets. Like Anand said, and you said, there are role models, but they're not being shown from a relevant standpoint. Everyone gets, rose-tinted, seeing the wrong examples. But everyone has relevance. There are 200 crore companies which can go public. There are 500 crore companies which can go public. There are 1,000 crore companies which can go public. There have been many examples of those, not necessarily in the cool venture-backed world, but outside of that over the last 10 years. And public market investors are very savvy. Yeah. They understand margins. They understand revenues. They don't care whether this is a SaaS business or a IT services business or a commerce business, as long as the math makes sense. So if you're able to show the right examples, I think you can direct companies over the next 2 years onto the right paths. And I think we should do it, not en masse, not in public discourse saying everybody should follow a particular role book. We should customize it for everyone, and I think we'll come out much stronger.
Well, Anand, I'm going to end by asking you the question that Karthik raised at the very beginning. How does it end? How do you believe it's likely to end over the next 12 to 18 months?
Shirin, in 2015 or 16, there were about 16 unicorns. Only half of them are around today. But the ones who are around are bigger and better, sure. So I'd say that, not all of them will make it, all the unicorns, but that doesn't matter, right? India will produce 1,000 unicorns in the next 10 years. And some of these will survive. I feel that more focus, cutting cost will actually reduce the flab. And maybe some of them will actually outperform without the capital, right? While becoming profitable. Because while we had a bubble and a lot of cash flow, even the adoption of technology products has increased significantly in the last 2-3 years because of COVID, right? A lot of industries had their, demonetization moment, right? So yeah, I think a lot of these unicorns will be around, and we are already seeing, just imagine the kind of people who are starting companies today. And today, the focus of rocket scientists is not to sort of, give a discount to a customer. That's not what they are doing. You have rocket scientists actually building rockets, right? So the next crop of startups would probably actual moonshots, almost literally, instead of moonshot in terms of valuations.
Yes. Yeah, well, that's been the tagline for us here on Young Turks for the last 20 years since we started this program, was that chase value, not valuation. And I hope that message goes through to the startup ecosystem as well as the VC ecosystem. But that's been our belief here on the program since the time that we started. But Karthik and Anand, thanks very much for joining us here on the first edition of the Unicorn Health Check. And we will have you back back as we continue this conversation around what's working, what's not, who are the relevant role models today for India's startups. Thanks very much for your time. Appreciate it. We will take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment with a lot more. Stay tuned.